Let's turn now to Marcus Bogdan. Good morning.
And good to be back this year.
Yes, happy new year. I'm not sure how happy it is when your cost of living is not really keeping up. But let's just stick here with the Omicron virus. And here in Australia, it almost looks like, even though there's no restrictions, people are choosing to stay at home. So we're really off to a bumpy start.
We've started in 2022 with definitely elevated risks. Omicron has been excessive, particularly in Australia, and illustrates that the pandemic is not just a winter virus as well. And that's having tremendous disruptions to supply chains and to staffing levels throughout the economy. And I think that is a risk to potentially for earnings profiles going forward. And at the same time, we've got central banks looking to tighten to be able to cope with these elevated levels of inflation. And so both of those factors, I think, are absolute risks at the moment. And we're coming off the back of a year where valuations at the starting point are elevated.
So in terms of what does all this mean for volatility, obviously we're not piling into cash yet, that is not going to help your performance. What are the options there, Marcus?
Well, I think that, on the positive side is that we're still getting earnings growth. The economy is still growing. And so that trajectory is really important in terms of underpinning valuations. The second element is what you've touched on, is that the returns from both bonds and cash are appalling, particularly when you look at real rates. And so dividend yields for Australian investors are still attractive. The dividend yield for the ASX 200 is still around 4%. And then on top of that, you've got the benefits of franking as well. And we do expect that those companies will be able to deliver sustainable dividends over the period. And some areas of the economy are still doing particularly well. I think what we're seeing in resources, and we're seeing in resourcing prices, that bodes very, very well for companies such as BHP and Rio in terms of their profitability and their dividends, and that's certainly been reflected in the recent strength in their share prices.
Yeah, we've just seen, of course, iron ore pick back up. That's sort of been a bit of a quiet achiever earlier this year. But in terms of the risks, like travel, of course, was on, off, on, off. Do we just avoid a theme like that because there's just too much uncertainty?
Well, we're seeing risks even broader than that. Even those essential industries that are really bellwethers of quality and stability. We're seeing that in consumer staple stocks and the disruptions that we're seeing in the supermarkets and on those types of businesses. We're seeing disruptions in healthcare through rising staff shortages, pressure on hospitalisations. So the risks are broad, but I would emphasise that those higher quality companies will be able to see through all of this and will recover. And I think maybe those types of stocks which have been really quite chronic underperformance for the beginning of January are now starting to look quite interesting.
So, of course, I think we've well and truly killed that growth versus value trade. What do you think about tech names? Is that something to avoid?
Well, I think that the challenge there on the technology side and those high PE stocks is the premium that they are trading still versus value. We are in an environment where interest rates are at record levels, and so they are going to start to move up over the course of this year, and so that will put pressure on future cash flows and valuations. But again, I would look at the stocks individually, and those companies that can continue to grow, that have got continued pricing pressure, are ones to still have on the watch list.
And as scary as it is, I know we've just gotten back to work. US earnings seasons kick off. Can we dig through the US earnings season and look for some clues in terms of our own earnings season? I mean, it's only just around the corner next month, such as supply constraints, labour. Are there issues that we can adopt here for our own earnings season?
I think some of those factors will absolutely be prominent in our sectors and the sectors that I've called out, and any of those companies that are sensitive to supply chains. And you're seeing the pressure there on the supermarkets. You're seeing the pressure there on logistics as well. So all of those disruptions will have an impact on Australian companies. It's whether the market starts to look through those in terms of the earnings that are presented, because the earnings that we're going to see are from the 1st of July to the end of December. And it's those forward outlook statements that we're going to see for the next 6 months, which I think investors will take a lot of attention on.
One thing that is another big factor here is our international borders, supply constraints, wages, pressures. Is that just yet another source of uncertainty here when we're looking at the Australian outlook for earnings?
Well, the issue around migration and the issues of labour have definitely been with us for some time, and companies have absolutely had to grapple with that. I think it's been elevated at the moment because you've got such staff shortages because of the pandemic, and I don't think any of those issues are really going to dissipate in the short term. And so looking at measures of future productivity, companies that are able to push through prices and also be able to continue to deliver online. And whilst the supermarkets have been under incredible pressure, they have been able to successfully pivot to providing those essential goods through online. And I think further investment there in data and automation will certainly help them in the longer term.